In this video, I'm going to talk about institutional investors because in speaking to investors that invest tens of millions of dollars and helping hundreds of people raise in excess of $300 million through our networks, tools, strategies, and contact base, there's a thing or two that we've seen about getting people funded. So quite importantly, there has to be a big difference between small check investors and big check investors. Big check investors are the types of investors that have a lot of boards, have a lot of decision makers, that there's a big decision-making process before they invest. All right. And that decision-making process is so big and complex and sophisticated, and there's a certain way to deal with them. And then there are other types of investors that are small, that invest 10K, 20K, 100K at most. And they're very small investors. So in general, I'm going to walk through a few ideas and frameworks for dealing with the institutional investors in this video, and maybe in other videos we're going to talk about the small check investors. But basically for institutional investors, I'm going to tell you what you need to do to come to the table. First off, you need to have a very specific and very articulate way of communicating with them. You're going to have to know the language and know how to adjust yourself in conversation. Because if you're talking to a sophisticated investor and they say something that you don't know, or if there's any signal that you don't know about fundamental business, then it could be a big problem. Because if you do that, then they won't even want to talk to you and you embarrass yourself. So first off, you have to have like a deep understanding of finance and a deep understanding of the sector that you're working in. So let's say you're raising capital for an institutional, for like a $100 million skyscraper in downtown New York or something like that. You're going to have to know about zoning laws, licensing laws, permitting laws, engineering studies, types of finance, mezzanine, debts, like senior debt, junior debt, preferred equity, common equity, waterfall structure. You're going to have to know about a lot of the details when it comes to the intricacies, because if you talk to somebody who understands that business and you have a signal that you don't, then it doesn't bode well for you, and you're just going to waste this time and you're just going to get high-level fluff. So first, you have to understand the material very well. Next, you have to make sure that you come to them with a package that's prepared if they're interested. So if you go to that investor, you know how to talk, you know how to talk the talk and walk the walk. You have to come to them with something that is prepared. And so that's why a lot of the time we focus a lot on the presentation of the materials, presentation of the teasers, or presentation of the data room, we call it. There was an investment bank, Cambridge Wilkinson, for example. They're very good. Whenever they send teasers out to people, they will tell you this directly. I mean, they send teasers out, and then people can choose whether they have redacted teasers where you hide information or you show the information. But the teasers are written in a very sophisticated way that signals a form of status. And so you have to learn how to talk to these sophisticated people with a certain level of acuity, and you have to have sharpness in your vocabulary and the way you speak. Because if you don't, you'll be picked up and it wouldn't bode well. So you have to learn how to talk and how to write properly to these types of people and structure the documents properly. Structure the documents properly, as we said in another video, boils down to talking about the legals, talking about the financials, talking about the marketing, and making sure that the legal documents and all the legal documents are they're of the standard that is expected in the industry. Subscription agreements, PPMs, operating agreements, LPAs, accredited investor questionnaires. They have to be done up to the standard that they're expecting. And let's talk a bit more about standards. So you talk to the institutional investors because, again, as I said, there are two types of investors you can speak to, right? You have let me just say small check. I'll say sub 100K, and then you have institutional. Like this is 1 million to 100 million. And it's a large number, but the reality is that these people are very serious. So know how to speak and write well for a sophisticated audience. You have to know how to speak and write well for a sophisticated audience. You have to know, you have to have the package, have the data room ready, proper data room. And these are the standards that you need. And you also have to avoid the ladders. So what do I mean when I say avoid the ladders? So the issue with the institutional investor is they always have something to say about their criteria. They're very, very prudent on their criteria, more so than a small check investor or an investor that you can sell from the streets that's accredited. And so these types of investors are very specific in what they invest in and what they don't invest in. So I'll show you one example. I've shown this example several times, like Presidio investors, or sorry, Presidio investors. Like, they're very specific. They need this at this enterprise value. They talk about so and so sectors, when you go into the details and then they tell you the details. But the idea with them is that they're very specific about what they acquire and what, like, the types of deals that they work on. All right. And so because they are, the thing with them is that you have to don't say anything that turns them off. And the ways to do that are to review their info. So on the web or otherwise. And this is the most underhyped thing. One of the key ways that I avoid getting into falling down the ladders, and I didn't even explain the analogy of ladder. The ladder is just like an idea from Snakes and Ladders. So Snakes and Ladders, to those who don't know, is just a game where, you roll a die, and then you basically land on the block. The ladders bring you up, and then the snakes bring you down. So this should actually be avoid the snakes. You have to basically don't say anything that's a trigger word that will get them not interested in your deal. So you have to avoid the snakes on the way down. And the way to do that is to know their criteria, review their intro, and then know their criteria, and also have sell pipeline and structure detachments. And this is may not be the way you're thinking. So when you say sell pipeline, if I say something and it's out of the person's criteria for an institutional investor, have a pipeline of other deals that may be in their criteria. So for me, like, nobody can ever tell me no, because at raises.com, we have so many people, so many sponsors, so many deals. So nobody can ever tell me no, because there's just infinite criteria. So you want to sell the pipeline, you want to sell the vision, and you want to sell the idea, and you want to practice detachments. So instead of being married to one deal that investors time and time again are saying no to, like, let's say you want to buy a business, you want to buy real estate. Instead of getting slammed with no's over and over and over again, just focus on practicing some detachment from the type of business that you want to raise money for. And say that, hey, I'd like to acquire this type of business, but if I don't, it's okay. I'll just find another type of business to acquire. Unfortunately, there's some founders, especially this is like founder-led companies that are, SaaS companies or so on. They are stuck in their own company and they don't think creatively, and they pigeonhole themselves into a type of deal that nobody wants to fund because they're emotionally attached to it. But if you practice detachment and structure detachments in your capital raising effort, then you can acquire businesses with other people's money without being super attached. So that would be the best way to handle that. And so that's mainly it, and then I guess, so investment analysts are similar, partners slash managing directors. Investment analysts are people, what's funny is that sometimes it can be young, sometimes, but people that their whole job is to analyze deals and underwrite deals. Partners are, people that are high up in the company. They may be investing as a general partner or a limited partner in a fund, or sometimes managing directors. So these are the people to talk to. And how do you find information? So you can use service providers. You can use like AI. So I say AI is the new service provider now. AI agents. You can use warm connections. Because like either it boils down to this: either they can come from you, or they can come from others. And if they come from others, either it's a service yourself. Uh, yeah, I guess services is a type of others. and you can hire employees. There's so many ways of doing it. But the bottom line is these are the ways to structure it when you're looking to find investors for your deal. It can come from you, it can come from others, and this is how to structure it. And that's mainly it. But the main idea is you have to essentially avoid the pitfalls and avoid all the snakes so that you don't say something that will trigger them to say no. You make sure you talk to the right people. You make sure you know how to find the info, because the more info you find, the less scarce you'll be. And the last thing I didn't talk about is the conversation. Pretty much, it's a Q&A format where you only focus on stating the things that they asked for or wants to hear or are related to capital. So let's say cash flow or capital appreciation. There may be others depending on their mandate. For example, if it's like pre-rev, they're looking for pre-rev looks for appreciation usually. So appreciation just means that the value of the thing will go up in value. Pre-revenue usually look for appreciation. You know, PE firms, PE firms usually look for EBITDA. So PE firms usually look for EBITDA, right? And so on. Like LPs and real estates, often they look for cap rates, and sometimes they look for capital preservation. So these are the benefits. All right. So this is the benefits. This is the what's. The how can wait. Let this be in the data room, or if it's asked of you. Because if it's something that's asked of you, then you can start talking about it. But it's divulged something that nobody asked for. This makes no sense, because why would you tell somebody something that they didn't ask for, that they don't understand the benefit from? Because it takes them from the logical thinking to the emotional thinking, or sorry, from the emotional to the logical. We wanted to keep them on the emotional. Everybody's super sophisticated and logical in this business, but ultimately everybody's emotional. So, the benefits are more emotional. The how is more logical. It's more like objection handling, prevention. So basically, the how is to justify the what, right? So the how is to justify the what. The who is part of like the how, because the who is you are the people that are executing the what's, because all they want is their results. But the who, these things can basically wait. So like prioritize this, because if somebody makes $1 million in a deal, they don't really care how they do it ultimately. They just want to see if it's possible to be done. So we want to prioritize the what, the benefits that they get out of it. And then you want to prioritize this after, or I guess put this second priority, the how, you know. So the who, show them you have experience. So basically just boils down to show them you have experience. An investment bank that raised over $25 billion per year. The ultimate thing they tell us is focus on management experience. So show them you have experience in sector. So in the sector with a number with N results, getting the what. So the what is the thing that they care about. The sector is the sector that they invest in, is their mandate. And then the results is, let me just say getting the what. So getting the what is results. So the result is getting the what. So that's how we want to structure it. So, I mean, that's pretty much it. when you look at it, why is kind of important, but that's more mission based. Where is part of mandates, and like these are more even less important. It's like it's important to have a vision for what you're doing, but it's more mandate driven. So you should already know these things from before. So mandate is like where, so that's more location, and why is more mandate. So like let's say there's like a social program, like a social justice program, or smart development goals by the UN. That's more like wide, and that's important for that, those types of mandates. That's pretty much what I'm saying is like focus on prioritizing the what. How do they benefit out of the deal? How much money do they make out of the deal? And do they make the money the way that they want to make the money, not the way that you want to make the money, you know? And then put this, so this should really be the forefront. And then this, after this, should be the everything after second priority. So everything after this should be like more in the data around things to review after all. Because these things are they're supposed to incentivize and supposed to reinforce how they actually make the money. So the mandates relevance, the people, and the how is supposed to reinforce the what. And the what is all they care about. They just care about how they're going to make money. They're just going to justify and prove why, how, and who's going to do it for them. All right. So it's really, again, Q&A format. The thing with Q&A format, and another thing is, this is about the conversation itself. Another aspect is tonality. I'll put this above here. So you have the contents of what is said, and then you have the delivery of how you say it. And ultimately, I hate to say it, but perfect English at all times. Don't hire somebody that doesn't speak perfect English. Then you have to have either skill or conviction. When I say that, I mean if you can't afford yourself to learn the skills of how to speak in a certain tonality, then you have to just have conviction and believe in what you're selling and what you're working on. Because if you believe in it, the conviction will come out as a byproduct. It's a shortcut to having good conviction. So ideally, the founder or the main principal is usually the best one to talk about it because they have the best conviction in what they're doing. So ideally, learn tonality, and yeah, basically, ideally, you learn tonality. So I recommend Jeremy Minor is okay. I'd say Belfort, but I don't want to mention Belfort because of obviously what happened and obviously the industry we're in. So we're not going to mention that. But check out Jeremy Minor. He's okay. And if no time, under talk and make sure you genuinely believe in what you're selling, building. You have to believe in it. It's almost like when somebody preaches, like the Christians that preach, or people of like any faith that preach or try to evangelize, if they believe it so strongly that it makes even an atheist or somebody with a different religion question their own reality, and that means they did their job right. So you have to really, 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 really believe in what you were selling. So that's the shortcut. So if you don't have any time, you have to just believe in it. So that's mainly it. And I guess some warning. So more for the latter side, avoiding the snakes. For the Q&A formats, don't. This is what my lawyer told me. Don't say anything or don't answer any question you're not comfortable answering. You're, I guess, highly uncomfortable answering. So you have to do like just don't. Like there's no need. it's not you're not being coerced into doing something that is terrible here. So you don't have to answer something that you don't feel comfortable answering. Don't go in unprepared. Spend, like I said, you spend like what, probably spend like depending on the conversation, spend like 10 minutes to even 30 minutes preparing, depending on the length of the meeting. So the more time you spend preparing, the better. I mean, that's mainly it. Don't do that. And then don't be desperate. So people can smell desperation. And even if they like your deal, they smell desperation, they'll go the other way and you'll be ruined, because when people are desperate, when people are desperate, they can smell it, and it can ruin somebody's terms, because people can get terrible terms because of desperation. So never be desperate when dealing with anybody, and then don't, how do I say this? Don't forget to follow up. So you have to make sure you follow up, on the call. As you're on the call, you make sure you set arrangements for the next call between the two calls. You have to be really persistent in following up. Um, you know, and you can't. So it's kind of like not being, you can follow up and be aggressive in following up while being desperate. And the best way to not be desperate is to be good at getting, let's see, you have to be good at finding investors. I don't know where it is. Yeah, you have to be good at finding the info. So be good at finding the info, because the better you are at finding investors, finding, you're good at finding investors, then you'll be good at finding the info. But that's pretty much all I got for this one. So these are the standards that you should make, and we'll make another video next time on small check investors. So it's probably on the channel by now. So click around on the channel by now if you want to see a video on finding the small check investors. So with this has been a really interesting video. I really like the format. And so if this is something that you'd like to do, you're curious about how it works, just make sure you head to raises.com. And so who am I, what am I talking about? Raises.com is the company we run. It's a company that helps people structure their private equity offerings, and we help people raise capital for their private equity offerings. And the way it works is people come in, step one, they book a consultation. They go and they click here, they book a consultation. And after that, it's just a quick call. People just go here, they book a call, and, they choose like the time, they pick a call, send some information about the deal, about what they're doing, and then if it's approved, we then get people access to a portal, and this portal will allow people. So if there's something that you'd like to do and you're interested, make sure you head to raises.com and to learn more. So we'll see you in the next video. Cheers.